Hello, and welcome to Virtual Investor Conferences. My name is Cecilia, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from First Resource Bancorp. Please note you can submit questions for the presenter in the box to the left of the slides. You can also view a company's availability in the one-on-one meetings through the Scheduled Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Glenn Marshall, CEO, and Lauren Rinaldi, President and CFO of First Resource Bancorp, which trades on the OTCQX Best Market under the symbol FRSB. Welcome, Glenn and Lauren.
Thank you, Cecilia, and welcome to First Resource Bancorp's Virtual Investor Conference, March 14th, 2024. As Cecilia said, my name is Glenn Marshall. I'm CEO and co-founder of the bank. I'm being joined today by Lauren Rinaldi, who is President, future CEO, and co-founder of the bank. Let's take a second and look at our forward-looking statement. Thank you very much. First Resource Bank was established in 2005 by Lauren, our board, many local business people who are shareholders, and myself. We wanted a community bank in southeastern Pennsylvania. Our original focus was Chester County. We still have many customers in Chester County, but we've grown past just being a Chester County bank in the last 19 years of the bank's history. In 2022, we formed First Resource Bancorp as the holding company for the bank to give us some capital flexibility. And Lauren has a slide in the presentation where she'll talk about the capital flexibility. If you follow the bank, you will have seen a press release from September of 2023 regarding my retirement on April 1st. Lauren will be CEO in 16 days. We've been working on a seamless transition for the last 5 years. As Lauren would say, I've been interviewing for this job for the last 19 years. And honestly, it's a cool transition. When we partnered up 19 years ago, this is what I envisioned, and I'm so happy to see it occur. If you're a reader of the book Good to Great, you'll get a couple of these references. From day one, we've always tried to get the right people on the bus, whether it be Jennifer McMullen, who's been with us a couple of weeks, to Natalie and Lisa, who were early riders on the bus. Lauren, I wanted to build a team that had depth, the ability to evolve and grow the bank. And this slide is a reflection of those 19 years of effort in building the team. Over the years, some of the folks in the team have changed seats on the bus, but we've always tried to surround ourselves with the right people. And I'm so excited as I get ready to retire that this group, where they can take the bank to the benefit of our stakeholders, our employees, our shareholders, and our local community. It's truly an exciting thing for me to see where they're going to take the bank. Every presentation needs a map, and Kristen's going to flip over. Thank you, Kristen. And an explanation. So the explanation on this is that the dollar signs are our physical locations: Exton, Westchester, and Wayne. These physical locations add up to $15 billion deposit market. But we don't limit ourselves to this triangle. Remote deposit, mobile banking, we can and do cover a much wider area than this physical footprint. We consider ourselves a hybrid community bank. So the best of the traditional community banking, a high-touch experience for the customers in a physical location. We combine this with technology. Now, this technology is now pretty much what everybody expects to have, but sometimes is lacking in a community institution. The high-touch, high-tech combination is our hybrid community bank. And yes, the technology bar continues to move. Things 10 years ago that were new are now sunsetting. But we've always tried to look at what's being developed and incorporate the best of those products into our product offering. We're going to be an early adopter, but we're not going to be an inventor. We don't need to be on every street corner with a branch, but we do need to be available to do customer transactions 24 hours a day. And the digital banking platform, remote deposit, is now just so ingrained in the bank from our early adoption, and it is our biggest deposit channel. And I'm going to hand it over to Lauren, who's going to jump in with the rest of the slides. Thank you.
Thanks, Glenn. Good morning, and thanks again for joining us. 2023 was a great year for First Resource Bank. It was a challenging environment, but we were committed to continued growth, which helped us generate the 13th consecutive year of increased profitability. Net income for the year was $5.9 million, which was 5% higher than the prior year. Total assets exceeded $600 million at year-end, the very first time we've reached that milestone. This compares to total assets of $517 million at the end of the prior year. In 2023, our return on assets and return on equity were strong at 1.09% and 13.77%. These were both down slightly from the prior year, but still very strong in light of the operating environment. There were no non-performing loans at December 31, 2023. Asset quality is as clean as it's ever been in our history. We're going to review these items in detail as we progress through the presentation. While many of our peers pulled back on growth in 2023 due to liquidity concerns, we were focused on growing in a profitable manner, taking advantage of opportunities in the market. Total assets grew $86 million, or 17%, from $517 million at December 31, 2022, to $603 million at December 31, 2023. And last year's growth was fueled by organic growth in the loan portfolio, consistent with most years on this chart. Fighting for deposits is not new to us. We've been battling for deposits in a highly competitive market since we opened almost 20 years ago, and we continue to see success in winning over deposit customers. Back in 2019, total assets were $336 million at year-end, and we've grown 80% since then, with our participation in the Paycheck Protection Program, PPP, during COVID serving as a catalyst to our growth. So let's look at the balance sheet in detail, starting with the loan portfolio. Our legal lending limit was just over $8.5 million at year-end, as compared to less than $2 million when we opened in 2005. Our loan growth has been aided by this higher legal lending limit, as we are better able to compete for A credits, which tend to be larger deals. Loan growth has been robust for the past 10 years, even when excluding the PPP loans, as we have done with this chart. All of this loan growth was organic, aided by some loan participations from other community banks, but there have been no loan pool purchases to date. Every loan we have on our books was fully underwritten by our lending and credit staffs. Total loans grew 16% in 2023, from $459 million at December 31, 2022, to $531 million at December 31, 2023. While loan growth was achieved in all categories of loans, commercial real estate loan growth led all categories with net growth of $49 million, or 13%. The commercial construction loan portfolio grew $13.7 million, or 39% in 2023. A good portion of those construction loans are expected to move to permanent financing within the bank once the construction phase is complete. We have a reputation in the market for being excellent to work with on construction deals, as this is a core competency of ours. Growth in this area was fueled in part by investors purchasing older apartment buildings, renovating them, and then in return earning higher rental payments. Also, the lack of 1 to 4 family housing inventory in our market has turned some buyers to building their own homes or renovating existing homes. Despite our significant growth, our geographic reach has been fairly consistent. In general, our loans are primarily within an hour to 90-minute drive from our headquarters here in Exton in Chester County. As of December 31, 2023, 91% of the loan portfolio was in Pennsylvania, with 4% in Delaware and 5% in New Jersey. The Pennsylvania portion is broken down further as 57% in Chester County, where we are headquartered, 15% in adjacent Montgomery County, 8% in adjacent Delaware County, 3% in Lancaster County, and 3% in Philadelphia County, with the remaining 5% in other local counties. Our CRA assessment area includes Chester, Delaware, and Montgomery counties, and 80% of our loans are within that CRA area. In addition to growing the portfolio 16% last year, we've grown it without sacrificing credit quality or sacrificing rate. We have implemented a pricing discipline, which ensures that we are not buying volume by being the lowest cost provider locally. We compete on service, and the growth has not slowed down as a result. This next slide shows the breakdown of the loan portfolio at December 31, 2023. We are a business bank, and the vast majority of our loans are commercial in nature. Commercial 1 to 4 family residential loans comprise the largest part of this pie chart at 29%. These loans typically represent investor 1 to 4 family residential loans. We have a large following of customers that buy and renovate homes for their rental portfolio or resale. This has always been a core competency of the bank, and we consider this type of lending as fairly low risk. Commercial real estate owner-occupied loans make up 20% of the portfolio. These are loans to business owners who own the building that they operate their business from. These owners typically like to have control of their building and the ability to build equity. Approximately 1.6% of the entire loan portfolio is pure suburban multiple-story office space, and all of it is owner-occupied. Therefore, we have little exposure to traditional office space, which can be considered distressed at the moment due to the shift to work from home and many companies who are now downsizing their offices. Commercial real estate owner-occupied is also considered low risk due to the owner-occupant. Commercial real estate non-owner-occupied loans make up 17% of the portfolio. And as the portfolio has grown, we have continued to refine how we look at CRE loans regarding square feet and purpose to monitor concentrations so that we don't get overweighted in any one industry or type. We're currently monitoring commercial real estate by 35 subcategories, believe it or not, including flex buildings, office, retail, industrial, and other smaller categories. We only have 2 loans which include a national tenant, and the exposure there is minimal, and the loans are performing. Retail exposure totals 5.1%, which is everything from tire repair centers, bars and restaurants, 3 shopping centers, and retail with apartments above them. Industrial and warehouse loans comprise 4.8% of the portfolio. There is significant value to these properties with outside parking in particular because they're in short supply locally. Flex buildings, which are typically a 1-story office warehouse combination, comprise 2.6% of the portfolio. And non-owner occupied office loans are 1.8% of the total portfolio. These office loans range from small office condos to offices with apartments above them, but there are no classic suburban 2 to 3-story office loans in the non-owner occupied office portion of the portfolio. Multifamily is up next at 13% of the portfolio. The vast majority of these loans are in Pennsylvania, with 1 deal in New Jersey and 2 in Delaware. There's been a fair amount of growth in this category in the past few years, as we had the ability to add larger loans in an area where we typically didn't have a lot of exposure. In the past, these loans had typically been 5 to 15 unit apartments, but we've had opportunities to participate in larger projects with fellow community banks as our legal lending limit has grown. Construction loans make up 11% of the portfolio. Typically, these are rehabs going into the commercial 1 to 4 family residential portfolio to be rented. We cater to spot lot builders who build less than 10 houses a year for sale, as well as the construction of commercial buildings likely headed to the commercial real estate owner or non-owner occupied portfolio. These construction loans are feeding the CRE portfolio in general. This is a core competency of ours as well, and we continue to operate in this space as a trusted lender to local builders. C&I loans represent 7% of total loans, and these loans are typically working capital lines of credit, term loans for equipment, or any other credit needs related to a business owner and the operation of their business. And consumer loans represent only 3% of the loan portfolio. That portfolio continues to run off, and we have no plans to expand into consumer lending at the moment. Okay, so over the past 10 years, we resolved several legacy problem credits to achieve a nominal level of non-performing assets over the past few years, including none at year-end. In 2023, we generated $87,000 in recoveries, offsetting only $7,000 in charge-offs, resulting in net recoveries of $80,000 for the year. This is consistent with net recoveries in the prior year as well. When it comes to collections, we always take the route to minimize the bank's losses, even if it takes longer to resolve that way. Last year, the provision for loan losses was negative. At the end of 2022, we had created a large specific reserve for one credit that was experiencing difficulty. However, that situation was fully resolved in 2023 with no loss to the bank, and the specific reserve was reversed accordingly. The adoption of CECL on January 1, 2023 was immaterial to our results. Non-performing assets to total assets declined from 17 basis points at December 31, 2022 to 0 at December 31, 2023. We only had one loan past due over 30 days over year end, and that loan is now current. Credit quality is strong, and we are constantly monitoring any signs of stress among our borrowers. This slide was a hot topic last year in the industry, and not much has changed over the year in our portfolio. And the table shown on this slide shows the composition of the investment portfolio at year end. At $27 million in book value, the investment portfolio is a relatively small portion of the bank's balance sheet, representing only 4% of total assets at year end. The U.S. Treasury securities are only purchased over year end for some tax planning strategies, so typically the portfolio is actually much smaller. Back in 2021, when deposits were surging, we resisted the temptation to deploy those funds into bonds, even though we were earning almost nothing on those cash balances at the time. We have always been a loan-driven bank and knew that we would have the loan demand for that cash eventually, and that disciplined approach certainly paid off. We firmly believe that First Resource Bank has no intent or need to sell any of these securities for liquidity reasons. Also, the majority of the portfolio are instruments that cash flow, therefore we are recapturing a small piece of the portfolio back each month. Our plan is to hold these bonds to maturity, at which point we will recapture these unrealized losses in their entirety. Even if we were forced to sell these securities at a loss, the bank would remain well capitalized. At December 31, 2023, book value per share was diluted 34 cents due to the losses on the available for sale portfolio. This 34 cents will be recaptured when rates come down and as the portfolio continues to amortize. Overall, the investment portfolio is immaterial to our operation. Moving on to deposits. Loan growth must be supported by deposit growth, and deposits have grown significantly over the years. Total deposits grew $68 million, or 16%, from $431 million at December 31, 2022, to $499 million at December 31, 2023. Strong growth in money markets and CDs fueled that growth last year. Many conversations with prospects start with a rate discussion on their part. We compete on service, as we still see significant disruption and opportunities from M&A transactions that occurred years ago. Also, the increase in fraud on business accounts have left customers of the bigger banks frustrated and looking for a local bank that is in their corner to help recover funds lost due to fraud. As mentioned earlier, we are a business bank, and our deposits reflect that, with 89% of our checking deposits being business accounts. We are able to compete effectively on business deposits, as so many of our peers charge excessive fees to these customers while also delivering subpar service. The First Resource Bank customer service experience, on top of virtually no fees, has proven to be a win-win combination for us and our customers. Money market and CD balances tend to be more evenly split between business and consumer deposits. We have worked extremely hard as a bank to improve our funding mix by increasing the percentage of checking deposits to total deposits over the years. The yellow line on this chart shows that ratio over the past 10 years. From 2014 through 2021, tremendous progress was made, as noted on this chart. Back in 2014, that number was only 10%, and at the end of 2023, it was 27%. While 2022 had a decline in checking deposits and 2023 was relatively flat, we have a robust deposit pipeline and dedicated deposit business development staff on board to help us continue to grow checking balances. Rising rates over the last 2 years, after many years of incredibly low rates, caused many depositors to shift funds to interest-bearing accounts for obvious reasons. We just hired a chief retail banking officer, Jennifer McMullen, who joins us with 31 years of a banking experience, all in the Philadelphia and suburban Philadelphia markets. And when I say just joined us, I think today is day 10, something like that, day 10 or 11. We are excited about the deposit opportunities that will be generated from Jennifer's previous books of business, as well as her imprinting her experience to create an even stronger sales culture across the bank. Another headline of late is the level of uninsured deposits in banks. At year end, approximately 80% of our deposits are fully insured or otherwise collateralized. This is a relatively high level of insured deposits, and our customer base has been resilient. We have been a member of the IntraFi Deposit Insurance Network since soon after we opened in 2005, so we've always been ready to address insurance questions with our customers. In 2022, the net interest margin was 3.74% as compared to 3.54% in 2023. This 20 basis points of margin compression accelerated in the second half of 2023, and that pressure has continued in early 2024. The loan portfolio is not repricing as quickly as deposits, and the pace that the Federal Reserve increased rates over the past 2 years was felt sharply in the deposit portfolio last year. This slide has a lot going on, but it really tells the story that no matter the rate environment, we have managed the balance sheet to achieve a net interest margin consistently higher than our peer group. The blue line shows the First Resource Bank net interest margin, while the red line shows the peer group margin. For 2014 through 2018, the peer group was Pennsylvania banks with assets from $100 million to $300 million. And for 2019 to 2023, the peer group was Pennsylvania banks with assets from $100 million to $1 billion. And the left axis shows the First Resource Bank and peer group margins. So the yellow line shows the average federal funds effective rate using the right axis of this chart. And the past 2 years has been a straight line up, followed by a pause at the top, as the Federal Reserve tightens to try to get inflation under control. While deposit rate pressure has definitely increased, we've managed to maintain a net interest margin well in excess of our peer groups, even when the peer group changed, comparing us to larger banks with more resources at their disposal. The First Resource Bank net interest margin did fall more sharply than the peer group margin in 2023, but I would argue that that was due to us continuing to grow the deposit portfolio significantly during a time of rising rates. On a pure dollar basis, our net interest income grew year over year, despite the margin decline. This next slide we've used since our very first annual shareholders meeting, as it has been of critical importance to us since day one, and the peer groups on this slide are the same as the previous slide. Our business model of maintaining a low physical branch count, coupled with an investment in proven, cost-effective technology, has allowed us to hire the best bankers out there to provide excellent service to our customers and still maintain lower overhead than our peers. This unique combination allows us to deliver the technology that customers expect with access to a team of top-notch bankers to support our hybrid community bank model that Glenn described earlier. Some companies are laying off employees to lower overhead, and we are continuing to grow the bank, which requires continued investment in our people. Yet we still see a decline in our overhead as a percentage of assets due to our growth. We are also leveraging technology to include an automated enterprise workflow solution to keep our employees working on higher level tasks and reduce the need to hire additional support staff in the future. We have embraced a work smarter, not harder mantra across the bank. The result of our balance sheet growth and net interest margin management, coupled with strong expense controls, has yielded the 13th consecutive year of record profitability for our shareholders. Net income for 2023 was $5.9 million as compared to $5.6 million in the prior year. The last few years were really fueled by balance sheet growth, with short-term PPP income more than made up with income from organic loan growth. When comparing the last few years of net income, keep in mind that 2020 included $1.1 million in PPP fees, and 2021 included $1.7 million in PPP fees. 22 had a nominal level of those fees, but big picture, replacing those one-time PPP fees and surpassing those 2020 and 2021 annual net income numbers in 22 and 23, it was a tall ask, and our focus on prudent growth was key to achieving that goal. Growing net income year over year in 2023 makes First Resource Bancorp stand out. In that same peer group referenced earlier, 73% of the banks in that peer group had lower net income in 2023 than they did in the prior year. We were very focused on not going backwards regarding profitability, and the team worked extremely hard to achieve that goal. We formed our holding company, First Resource Bancorp, in 2022. And having that holding company in place now provides us with enhanced capital options in the future. We can now issue debt at the holding company, which could be downstreamed as a common stock investment in First Resource Bank to support its growth in the future. By issuing debt at the holding company, we can limit and/or delay the issuance of new common shares to minimize the potential ownership dilution to existing common shareholders. We have no plans to issue debt in the near term, but when that time comes, we will benefit from having the holding company structure already in place. Another item to note is that there have been 9 5% stock dividends issued since 2005. An original $10 per share investor at the bank's opening in 2005 now carries a cost basis of approximately $6.45. Last year, book value per share increased 9% to $14.91 at December 31, 2023. So we've been trading at about 90% of book value over the past few years. And as a thinly traded stock, we trade more on the perception of banks as compared to our own results. We are focused on continuing to grow the bank, sharing our story with the right audiences, and being good stewards of our capital to close the gap between book value per share and market value as an initial step. At the end of February, book value per share was $15.16 with the market price of $13.10, and yesterday the stock closed at $13.60. This next slide shows 1-year stock performance from March 8th, 2023 to March 7th, 2024 when these slides were finalized. March of 23 was a tough time for bank stocks due to the regional bank failures at that time. So all indices on this chart, other than the S&P 500, take a dip right out of the gate and then slowly recover. We continue to take advantage of opportunities to share the First Resource Bank story with investors and market makers to increase awareness of our stock. Okay, now that we've gotten through all the numbers and the technical content, now let's talk about the fun stuff. This is a photo from one of our employee outings last year. We love to dress in First Resource Bank blue and smurf it up, as we call it. When we go to a networking event, you can't help but notice all the blue in the room, and I've heard it drives other bankers crazy, which I absolutely love, which means we're going to continue to do it. Our reputation in the market is attracting high-quality talent. High-quality bankers want to be a part of this team. That talent doesn't always line up with the budget, and we will always look to make the long-term play by hiring well-connected, talented bankers when they are available. I am fiercely protective of the bank's culture. 19 years in, and Glenn and I still interview every single candidate before they receive an offer, and I will continue that practice as long as humanly possible. We take a lot of pride in being named a best place to work because that is only earned via an anonymous survey sent to all employees. We listen to their feedback and take action where needed. We implemented a mentor program years ago based on survey results as an example. We truly believe that taking care of the employees results in employees taking care of the customers. I could fill this slide up with all the accolades we've won over the years, but I'll just share that we've earned the best bank in Chester County for the last 7 consecutive years and best of the main line for the past 3 years. Every bank says they have excellent customer service. The First Resource Bank team truly goes above and beyond at every turn to outservice our competitors. Our employees are invested in our success, and it shows. Let me provide an example of how crazy we are about customer service and how every area of the bank plays a part in this award-winning service. We had a customer who was having an issue submitting their ACH payroll file on a Thursday afternoon for their employees to get paid the very next day. The issue was with their payroll software, absolutely nothing on our end. They had just made a change in providers, and this issue was a result of that. The company reached out to us as they were not sure how to fix it, and of course this all started at 4 p.m. We got the retail, cash management, operations, risk, and management teams involved to assess the situation. We were going to make sure those employees got paid the next day one way or another. And again, this was no fault of ours or our systems. We then reached out to our data processing company and extended the ACH cutoff time for the entire bank by an extra hour to give this one company the time that they needed to figure out the issue with their file. And at the same time, we were developing a plan B to wire each employee their payroll the next day if needed, making sure that we had the internal resources lined up the next day to do so if needed. There was a group text, including Glenn and I. Long story short, that ACH file got processed about 6:40 that evening, and those employees got paid. We will do things like that every day of the week for our customers, and that's what makes us special. Moving on to this next slide, I'm so grateful for our customers who take the time to share their experiences with us online. Our employees are actively asking for the reviews and seeing great success. Each of our locations has a 5.0 rating, and this perfect 5.0 across all locations is a source of pride within the company, and it's evidence of what the team is doing day in and day out for our customers. Every week, we share ratings with the entire company, and I email each reviewer a personal thank you for taking the time to share their experience. Creating raving fans not only creates lifelong customers, but it also helps to generate new business. Thank you for joining us today. We only have a little bit of time for some questions, but our contact info is here. Feel free to reach out to us now or after the call. Really, don't hesitate to reach out from us. So I have a question here. Just give me 1 second. Do we have any plans for geographical expansion? So the use of technology, I think Glenn had mentioned 61% of our deposits are being processed through remote deposit capture. And that mechanism, the entire network of all of our scanners out in the universe costs me about $8,000 a month as compared to a branch, which all in costs me about $50,000 a month. So we are not itching to put up another physical branch anytime soon, but we are using our technology and hiring people, employees that have books of business from different geographies to help us expand. Sorry, I can't get to